Welcome back to the channel. So I've got two interesting buy rights I'd like to share with you. So for those of you who don't know what a buy right is, this is the definition. It's a strategy requiring the simultaneous purchase of an underlying security and the selling of at or out of the money call options representing the same number of shares. The buy right is like renting your shares to the stock market. Okay, so let's put this into some actual numbers with two pretty good trading ideas that have just come across my desk. The first one's with Macquarie Bank. So in this example here, we've bought Macquarie Bank at $159.57. By owning the shares, you're entitled to its upcoming dividend, which is $2.55 fully franked. What that means is has tax paid at the company corporate rate. Now, it'll go ex-dividend next Monday. So if you buy the stock today, Wednesday, Thursday, and Friday, you'll get the dividend. If you buy the stock next Monday, you won't get the dividend. Now, by selling the out-of-the-money March 24 $170 call option, that the option market is going to pay us roughly $3.56. You can see here, this is the actual bid and offer of the actual live options market. At the time that I looked at the particular trade, it was bid 327, offer 384.5. So I've just taken the middle price for the purposes of this example. So when you put that all together, there's 135 days until the 21st of March comes around in the corner, and then two outcomes will actually happen with this particular trade. And this is where I can say something that's a matter of fact. You see, Macquarie at the end of March will either be above or below $170. That's a statement of fact. Now, if it's below $170, you are not going to sell your shares because no one's going to buy them off you for $170 if they can go into the market and buy them for less. So based on the purchase price of that $159.57, your standstill return is about 2.67%, and we annualize that out, it's about 7.2%. That just simply means based on its purchase price, given the dividend received and the options premium received, that's effectively the return there. On the other hand, if Macquarie Bank is above $170 come the end of March, then you will be obligated to sell your shares at $170. Now, if you do that, then you're going to make a capital gain. It stands to reason if you bought them for $159.57 and you sell them basically for $170, you're basically selling them for a profit of about $10.43. So when you then take that gain into account, it works out to be a return of about 8%. Or annualized around 21.7% return when it's on an annualized basis. So again, it's just a very simple trade of buying an underlying stock, selling it out of the money call option, and just waiting it out. Now, the second example that we could do the same strategy on is Westpac Bank. Now, Westpac Bank, in this example, is $21.31. They just recently announced their full year profits, and they've declared a dividend of 72 cents. But they go ex-dividend on Thursday. So you could buy it today being Tuesday, you could buy it tomorrow being Wednesday, but come Thursday, if you buy Westpac, you won't get the dividend. So if you buy Westpac today at $21.31 and you go out to March and sell the $22 call option, the market's going to pay you 40 cents. So again, like Macquarie, you're owning the stock and you're selling the out of the money call. Now, in Westpac's case, if the Westpac come at the end of March is below $22, no one's going to buy it off you if they can buy it in the market for less. So that means the call option you sold will expire worthless. You still retain your shares. No one will be buying them off you. You're not selling them. And you basically make a standstill return there of about 4% or about 11% annualized. If you are exercised, meaning Westpac at the end of March is greater than $22, you will sell your Westpac shares for the strike price of $22. You will obviously make a capital gain, but you've kept the 72 cents dividend, and you've also kept the 40 cents options premium. So all up, you make a return of about 6.19% or annualized around about 16.75%. So you can see there are a bit of a variation in the returns, and that's got a function to do with obviously the underlying share, which in this case was Macquarie and Westpac, and it's probably fair to say for those who follow the markets, Westpac's got a lower implied volatility than, say, Macquarie Bank. Basically, the higher the volatility you have in the underlying stock, the greater you will get in the options premium, because it's just a reflection of the risk. Anyway, that's an example there of two current buy rights that are worth considering. It's a great way if you're already prepared to own these shares in your portfolio. So you're already accepting the market risk and owning Macquarie and Westpac, because you're there to, because of the growth in the company over time. You're there for the dividend flow that they're going to pay out twice a year. But this is a way to really enhance your return. Effectively, by selling the out-of-the-money call option, you're doubling the dividend that you can get. And if you just sort of repeated this even twice a year, or managed to slot it in 3 times a year, you can really enhance the income yield in your portfolio. So I hope this video has explained what the buy right is, given you a look at 2 current examples that you could employ today. And if you want to know more about what the buy right is and other option strategies, I suggest you go to the Andika website, find the OME for Options Made Easy tag or tab, click on that, and there's plenty of videos there you can watch. And there's even a book titled Options Made Easy, written by me back in 2002, that explains how the options market works. Anyway, appreciate it. If you like the video, give it a thumbs up. Feel free to leave me a comment below. And until next time, take it easy, and we'll see you then.